Hi, this is Andy from Two Graybeards, and today I'm going to do an explainer on a topic we should have started with called asset allocation. And that topic will cover a few things. Firstly, what is beta and why does one get rewarded for investing? Second, what is alpha and how does one, if one has alpha, how does that affect long-term investing? And three, confidence and humility and the balance between investing, assuming you can time markets, and investing for the long term, and where that leads us. In particular, Two Graybeards' portfolio is a long-only portfolio. We have limits on the minimum amount of equities we are willing to own, meaning we're not willing to own less. And yet we're extremely defensive right now, which makes one think, why don't we own less? Or for that matter, why aren't we short? And the reason is humility. When one is, and I'll come back to that at the end, but when one is playing the market, when one is investing, market timing is extremely difficult to do well. Most investors fail at market timing. And Nick and I have a lot of experience, but we're humble enough to know that we could easily be wrong on our market timing. And so because of that, we'll never be short. And because of that, we'll have a minimum equity exposure. And because of that, we'll be very cautious to be underinvested like we are now. It's a worrying consequence of our alpha process that we are heavily underinvested. And we take that quite seriously and have to have very good reasons to be underinvested. And so we feel strongly about that at the moment, but we balance that with humility that we could be wrong. So let's come back to why one invests. And the simple reason is those who want your cash to consume today, and that includes the private sector and the US government, who needs to pay its bills to the private sector and spend the taxpayers' money in excess of actually what they take in. So they have to borrow from us to pay someone else. And in the private sector, there are people that want to buy a car today and need to finance it, or want to buy a house and are willing to take on a mortgage, which is just another thing for an investor to be considering as one of their ways to deploy their savings. So that's one thing they may want to consume. The other thing is they may want to invest. They may want to build a factory. They may want to start a gold mine or an oil well, or they may want to, a government may want to build highways, or an individual may want to open a lemonade stand. And each of those things requires an upfront investment that, to the person that's making that upfront investment, they expect to earn a benefit from their real economy investing. And for that, they need cash. And so savers have cash, and savers can just sit on cash. Right now, it's yielding almost 5%, and it's soon going to yield it more than 5%. It's very attractive, certainly a lot more attractive than anything we've seen in the last 20 years. So how does one convince somebody who has cash that's earning 5% to hand that cash and then to someone who wants to consume or invest in the real economy and take on risk that they might not get the money back, or they might get less back, or they might need to themselves consume, or decide to open a lemonade stand and need to raise cash. And so they'll have to sell those assets and take whatever the prevailing price is when they de-invest. So they take on risk. And just like a casino, casinos are a bad example because people take on risk sometimes for a negative expected return, but there's some thrill in it. Investors are a little bit more cautious about how they take on risk. And they don't get the bright lights and comped hotel rooms or free drinks or any of the other things that make Las Vegas entertaining. So investors expect a positive return when they part with their cash. And let me tell you this straight out. There is not a single investor who takes their cash out of their account and invests it, who expects their investment are going to lose money. All of them have an expectation of a positive return. Now, sometimes that expectation is a bit high. There are times like the internet bubble or the the late 80s in Japan, where people had unrealistic expectations for their returns. But over the long term, at any one and at this very moment, the dynamic works that when you have cash, the only way you'll part with it to take on risk is for a positive expected return. Now, it may take you many, many years to deliver a high or even a above cash expected return, but it's bound to come. And I'm not just saying this, you can look at any form of diversified, balanced investing. The market portfolio, which is all investments lumped together into one index. An all-weather portfolio, which is the namesake of the firm I used to work at, Bridgewater, in which they think they do a better job balancing a portfolio to all the possible outcomes that could happen in the world, versus the 60/40 portfolio, which is a very popular version of a long-only portfolio. Each of these generate a return in excess of cash over the long term. Now, last year was very bad. That was one of the years in which that type of portfolio, all long-only portfolios that are diversified and balanced, lost money, made a return less than cash. And that's not supposed to happen very often, but it does. And so you still have to look at it today and say, what is the expectation for the next 25 years? And the answer to that is you should expect a positive return. So by and large, if you are an investor, your job is to be 100% invested in a balanced portfolio of stocks, bonds, across commodities, gold, across countries, across currencies, broadly diversified to any economic climate. And sometimes you're going to have a year like last year. And so, for the new investor, yeah, it's a bummer that, if you invested at the end of last year, it's going to take you years to get back. But the forces are in your favor for holding assets every day. So why are we not at 100% at two graybeards today? And that is about market timing. Market timing is owning assets is called, I call it label beta. Market timing, meaning trying to beat the market, I label alpha. And let me tell you, it's hard. Most people don't have alpha. In fact, I have low confidence that I have alpha, and that's because it's very hard. If you look at all of the people in the world that are trying to beat the market, I mean, that's the whole game, right? You're supposed to beat the market. It's very hard. Almost every, and I mean every mutual fund that tries to beat the market on a risk-adjusted basis fails to beat the market. You'd be better off just buying all the stocks than have some stock picker choose stocks for you and, shift out of things that they don't like anymore into things that they do, seeking outperformance because they fail at it. Long history of failing to do it. And yet people show up every day confident that they can beat the market. It's very hard. Humility is important. And so it still comes down to the idea that if you really don't believe someone has alpha, and how does one manage their portfolio through time, you should take all your long-term savings and have it diversified in a diversified long-only portfolio at the amount of risk that you're comfortable with, meaning the balance of cash versus assets should be, have the cash that you need to be comfortable. And then the amount that you're willing to take risk should stay at 100%, whatever that is. And, people's cash needs are different. You might have a wedding planned. You might have a college to pay for. You might have a car that you'd want to buy, or you may need to upgrade your house for some reason. Any of those things are money that you can't put at risk. You should invest that very differently if you have a very short-term need for cash, because you can't take risk because you're going to need that cash. But the amount of cash that you really can look at and say, I'm in it for 25 years. I'm never going to change I'm never going to touch this money or have a need for it. I plan on retiring off of it, and giving some to the next generation, whatever. That money is the money we're talking about, the truly long-term money. And with that, and all the other money, just to be clear, all the other money should be very conservatively managed because you're going to need it soon. So the amount that you're not going to need, I'd have 100% invested in a diversified portfolio of assets that have risk, because risk pays a positive expected return through time, in excess of what you get for taking no risk. So that's the simple answer. Now, let's talk about alpha. As I mentioned, no one has it. It's very hard. Some people may. I'd like to think I have some alpha, but I'm very humble and uncertain about that. So I'm constantly checking to whether that's a reasonable assumption. And when I think I have no alpha, or for some reason I'm being told I have no alpha, I go back to my touchstone of 100% allocated in a long-only portfolio, because that's the long-term place where I want to be with that money, which comes down to, now, with humility, how would you structure a portfolio knowing that your touchstone is 100% diversified beta? The amount that you shift from that represents your degree of confidence in your market timing skills. And I said, that's very hard. And so the idea that I would venture so far, that Nick and I would venture so far from our touchstone portfolio to actually being short, not only 100% in cash, but actually betting that that portfolio, or a portion of that portfolio, was going to go down, would in our view represent a dramatic overconfidence to the point of potential arrogance on our ability to time markets. And so what did we pick? We picked things. We said, okay, well, what guardrails should we have so that our touchstone stays within sight of our portfolio at all times? And so loosely, we're at as defensive as we could be, with a 50% allocation to risky assets. And we've decided to have a 20% allocation to equities at all time, no less than 20% allocation to equities at all time. And that's just saying that's our border. Now, of course, sometimes our alpha views are strong enough that we might say, gosh, it's really a great time to be short equities. In fact, Nick and I each separately run our own alpha portfolios. But that's a completely different topic, and is a portion of our total allocation that we use for our long-term savings. It's not overwhelming our long-term beta so that we would somehow be short assets in aggregate. So now let's talk about the difference between, 50% and 70%. There isn't much. There is a big difference to me between 50% and, say, 100% allocation. Right now, we think we should be defensive. And, that's a very defensive posture, to be near our minimum in equity allocation and 50% in cash and cash-like investments. That's really quite cautious, quite defensive. We have a strong view, but it's still 50% long. And that's because our strong view is an alpha view, and we may be wrong. Should it be 70%? Should the equity minimum be 25%? Possibly. We'll see it through time if our rules need to evolve. I could easily see a 70% minimum invested amount, knowing that our touchstone is 100%. And that'll just swing. That rule potentially could change based on whether we're delivering alpha, recognizing that in the long term, 100% asset allocation is about right. In fact, our alpha view could one day, I expect it will, within the next 3 years, be not only 100% allocated to a risky portfolio, but being levered and having 130% invested. But would we ever double lever our portfolio? No, because that, again, is not good long-term investing and is a market timing levering up of a portfolio, which we may not have. And so we guardrail ourselves about that, with that humility and lack of certainty that we can deliver alpha. We think we can. We've had a long track record in our separate lives, and hopefully we'll have a long track record in our two graybeards lives that we can deliver alpha. But again, very, very hard. And so if you're not at 100%, again, with your long-term money, diversified beta, you're betting. And just make sure when you're betting that if you're betting that markets are going to go down and the market goes up, that you don't miss it all because you have made such a large bet to stay in cash. Or also make sure that if you're long 100% and the market falls, that you don't sell out because you were too heavily allocated. That's the most important thing. Whatever your allocation is, if it's not exactly what your risk tolerance can handle, you're making a bet. And making those bets is very hard. So anyway, that explains our asset allocation. It will stay within that framework, and we'll constantly be judging whether we have strong views or not. And our portfolio will gravitate through time to be 100% allocated over the long term. That's our objective. Right now, we're defensive. Thanks for listening. Tune in to the next explainer. Ask questions, because that's the germ of an idea that allows us to deliver these explainers.